Hold on, hold on, hold on. Don't click away. Ah, Professor from Tolarian Community College asks, not me specifically, he asks in general. Do you think it's fair for WotC to raise prices 11% during a period of unprecedented revenue growth and sales? Or do you think this is not something that should have happened? So, he made a really good video about it recently, and I love Professor. I think he's very good. He plays the kind of even-handed, middle-of-the-road kind of person. And I think he's very valuable to the community. And I think he made a really good video talking about the price increases. It was entitled something like, "The price of magic is about to get a lot higher." A typical kind of like moderate clickbaity title that we try for on YouTube. There's a fly flying around in here. Uh, you know, to his question, is it fair? I don't like the word fair. Fair is subjective. We each define what we think fair is. And so I don't really get emotional about these kind of things. I've been investing long enough, and if you take a Myers-Briggs personality test, I come out as the quintessential engineer, which means that I have problems with emotion and expressing them. I look at everything very mechanically of what can we measure? What do we have data about? What can we know and how can we know it? Things like that. And so I think that's a good thing as an investor. You don't let those kind of emotional things get in your way. And so framing this question in terms of fairness, I think that's not the way I'm going to answer it. And so what I would like to talk about is, why do companies do this? Why does a company have a period of unprecedented revenue growth and sales, and then also weeks later signal that they are going to raise prices on average 11%? And so don't shoot me, I'm just the messenger, but here's why companies do that. So possibly if you're on my channel, you're some type of investor of something. Most people on this channel are. If you're not, that's fine, join us. And if you have, let's say, a 401k through your job, you have some money taken out of your paycheck every week. It's put into the 401k, into various funds. Maybe you choose where it goes. Maybe your company chooses for you because you are not interested, or you acknowledge that you just shouldn't be picking for yourself. That's fine. Either way, you expect that money to grow at some certain rate. And so you have taken that capital, which is dollars that you got for doing your awful job that you hate, and you are buying an asset that you expect to appreciate at a certain rate, so that in the future you can get back not only the originally invested capital, inflation adjusted, but something additional. That's what you're looking for. And so essentially this is return on invested capital. And likewise, when we buy magic cards, sealed product, we put it away in a closet forever, we are making a wager that the return on invested capital will be high enough to overcome inflation and hopefully overcome other alternative bets we could have made in the stock market, the crypto market, the other collectible spaces, real estate, whatever. So you're essentially making a bet that these things you have invested your money into will return not only good enough returns to satisfy you in the future, but they will generally beat most other assets. And please do not try to fool yourself into thinking that you can choose the assets that will beat other assets all the time. Sometimes you get lucky, but you are only just lucky. You are not good. I am not good at this. I am patient. And I am unemotional about these things. And so if you have patience, that's the most valuable thing you can have when investing. If you are willing to let a sealed box sit in a closet for 5 years, it does not matter if this were a Kaldheim collector box. Still $150 today. 5 years, it'll be more. Don't worry, be patient. So, when you invest that money in your 401k, you are expecting some kind of return. If you were not expecting some kind of return, you would put it in a crappy savings account at your bank, because you'd be happy with 0.25% interest, or maybe it'll go to like 0.5% or 0.75% now that the Fed raised the prime rate. You'd be happy with that because it's a lot less risky. It's FDIC insured up to $250,000 or something like that. And you would not have the stock market risk. So if you were not concerned with what kind of return you got on your money, you would just go put it in something much safer. Sovereign debt. municipal debt of municipalities that, responsibly manage themselves, or high-grade corporate debt, things like that. But the shareholders of Hasbro, they have capital also. And this is where people will start getting really upset. We're talking about shareholders, we're talking about evil rich people with money to invest and things like that. Again, I'm just telling you why it is this way. You can like it or not like it, whatever. I don't get emotional about it. I don't have a like or a dislike. I simply acknowledge that this is why it is. So the shareholders of Hasbro, which owns WotC, not only those shareholders, but Hasbro itself, the management there, they look at what they own, which is WotC, and they say, I need a certain return on invested capital in order for it to be worth my money being tied up in owning Wizards of the Coast. And so you will say that whether you are Hasbro owning WotC or a shareholder owning Hasbro and by proxy owning WotC. And you will say, if WotC cannot deliver certain returns on invested capital year over year over year, I might as well get my money out of this investment. I either need to sell the company to someone else who thinks that they can cause it to provide the kind of returns on invested capital that they desire from their investments, or I need to bust the company up and sell off its assets, basically, chop it up and sell it for what you can get. And this is something that businesses do all the time, especially conglomerates, which is essentially what Hasbro is acting as here, since they own Wizards of the Coast. A good example of this is sometime in the mid-2010s, there was a company called Sikorsky Aircraft, and probably some of you have heard of this. They make the Black Hawk helicopter of Black Hawk Down fame. And over the decades, Sikorsky has basically grown so fat and lazy off of Black Hawk contracts with the US military and allied foreign militaries that it had completely stopped innovating, stopped offering competitive commercial helicopters into the commercial market. It had stopped really trying. It had basically said, look, the US and allied militaries operate 6,000 or 7,000 of these Black Hawk helicopters around the world. We don't have a problem. They have a problem because they can't change. They rely on Sikorsky for upgrades, spare parts, maintenance, training, all of that. So essentially, Sikorsky Aircraft Company had just grown fat on the largesse and had stopped trying to be a productive, growing, innovative business. And the result of that was that their return on invested capital had fallen to somewhere around 2 to 3% per year, which is abysmal. It's abysmal for any investment. It's abysmal especially for businesses, because businesses, they're supposed to be a lot more risky and have potentially better outcomes. And it's that alligator mouth that Rudy talks about. If you're taking more risk, you have the risk is downwards. If you risk worse outcomes, you better be getting better rewards for it in exchange. And so essentially the company that owned Sikorsky Aircraft, which at the time was United Technology Corp, I think they were called. They're a weird conglomerate that owns Otis Elevator and Trane Air Conditioning and a bunch of other weird, stupid, unrelated companies. But they also own an engine company. I don't know if it's Pratt & Whitney or Rolls-Royce or who, but they decided, hey, Sikorsky's only putting off 3% return on invested capital. Get rid of it. Sell it to somebody who thinks they can get better return on invested capital. We will take all the money that we get from selling Sikorsky and we'll invest it in something else. And so that's the same kind of calculation that Hasbro owning Wizards of the Coast is looking at, and that shareholders owning Hasbro owning Wizards of the Coast are looking at. They expect that their stock value, their enterprise value, however you want to measure it, the book value, whatever, that is going to increase by an acceptable amount every year. And of course, every individual involved in this calculation has their own particular definition of what acceptable is. Don't get emotional about that. And so they're going to look around and say, well, I could just buy an S&P 500 index ETF and get, on average, 8, 10, 12% per year compound annual growth rate. If I can't get that out of my ownership of Hasbro, what am I doing? And so that's what management is saying. That's why companies will make record profit, but then they will turn around and increase prices by 11%. Because Hasbro is looking at this and saying, if we cannot continue to grow WotC's performance, then we need to either sell it to somebody who thinks they can, and by the way, that someone they would potentially sell it to, they will make it reach that performance by raising the prices. So either sell it or bust it up, sell off the IP, get what you can and get out. And that's the reasoning. It's kind of hard to accept, especially if you're maybe a younger person who has not had as much experience investing, or maybe you don't have as much invested assets. Your mindset about these things changes, and your incentives become differently aligned as you get older, as you become wealthier, as you become more experienced as an investor, and you realize, oh, these things that people like decry as, the evils of capitalism, they actually serve a good purpose. But you need to keep in mind that part of the reason why you start to think they serve a good purpose is because it now benefits you. So make sure that you think objectively about these things. Do they really serve a good purpose, or do I only like them because the incentives are aligned with me? So always keep that in mind, just in general. But that's the reason why WotC would say, they would have unprecedented revenue growth and sales, and then raise prices 11%. So in terms of how businesses are run, if you have a business that's contracting, that's awful. You really need to turn that ship around, or you need to break up the business and get out. One or the other. Businesses really shouldn't be stagnant in growth over long periods. Over short times, that's okay. 2020 was a great example. A lot of businesses shrunk in 2020. But during normal times like now, businesses should be growing. Hasbro expects WotC should be growing. It is how it is. Don't shoot the messenger. I'm just telling you why prices get raised 11% after record revenue and profits. Let me know what you think. I know some people get really upset about these kind of topics, but the sooner you can become unemotional about your investing, the better at it you will be. And I will tell you, in these last several months that stocks have been going down and down and down. I have only sold a partial position of a single company that I own. And it's a company that has run up really high over the same time period. So I've sold parts of it to buy some other things that are down. You should not be panicking right now. You should not be panic selling. If the thought ever crosses your mind of, I have to protect what I have left, that is a terrible decision, and you will only make bad choices because of it. So become unemotional about your investing, and more of these things will start to make sense to you. You'll be at peace about them, and you will be a better investor. So let me know what you think. Like, comment, share, and subscribe. Join me on Final Trade. Thanks a lot.